Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. It is about 2 o'clock on Saturday, and we're looking at weekly chart of the S&P 500, and we had another up week, pretty strong week actually, a gap up and then run up. You can see right here, I don't know, maybe we didn't gap up, but we gapped up on the open, but not outside the previous day's range or the previous week's range. But we ran up pretty much all week. So there's a lot of risk right here at the time in the market, and we're going to cover some of that in a minute, some internals and things like that. But the market's been very strong. We got new highs. We got a new closing high. I mean, there's just, there's a lot of quote unquote positive things. There was a job report the other day. It was like 255,000 jobs were created. I don't want to get into the economics. You can listen to that somewhere else. But there is a lot of, for example, I don't know if many of you know this, but when a job is lost, it could be let's say a breadwinner type job, but then let's say if that person has to go get two $10 an hour jobs, that counts as two jobs. So you've got this kind of shift going on in the economy from real breadwinner type jobs to lower level jobs. And so the quantities of jobs that are being created in the economy is a little bit distorted. Actually, it's quite a bit distorted. But even that, there's some weakness you can point to in the economy, and we're going to look at that because there's some it just adds to potential risk, and I want to make you aware of it. So the VIX is low. VIX is as low as it's been, and I don't know how long. That usually points to some risk. I'm not sure here if this is a new low for the VIX. I'm gonna have to probably zoom in here so you can even see it to get it back up on the screen here. You can see 11.39. So we've even closed below this low as we're outside this box. This is a very, very dangerous situation if you've got money at risk in the market. Very, very dangerous. I don't know if there's just a lot of manipulation going on in the market or what, but this is highly unusual. And personally, if I had money in my 401k or whatever, I would just take it out and set it on the sidelines. There's just a lot of weird, kind of unusual stuff happening in these markets. And, if you can't figure something out, it's best just to sit on the sidelines and wait till it becomes more apparent. We've been looking at something, I've been telling you about the 13-week Treasury yield, and I've been saying that there's no way the Fed's going to raise rates unless we're above this line, and here we are now quite a bit below the line. The line I'm speaking of is this one right here, this line right here. So we're quite a bit below this line. Of course, those could spike up, in pretty short order, but it's going to be at least several weeks before that happens, if it happens at all. So this does look, not that you would trade this, but this does look somewhat corrective. So this could have been the first move up, the first pullback, and now we've got boom like that. But when we get above this line, you watch, the Fed's going to start raising rates. And there's some things happening that we can look at that might mean that we're going to pull above that line. So here's the 10-year Treasury. This is the most important interest rate in the market. It's not controlled by the Fed. It's controlled by the bond market. And you can see here we've pulled back to new lows back here. And then now we're starting to rally up. Had a really strong week this past week. And if this heads this way, this will this will pretty much kill the economy. So just be very, very careful. It'll kill your 401k as well too. So just be very, very careful in this market. There's just a lot of craziness. I'm not going to look at the worldwide markets yet, Germany, Japan, because I have something I'm going to show you here in a minute that will show some of that. I think it's pretty interesting. But let's switch over to oil real quick and look at oil. Here's a very long-term chart of oil. This area back here, this low before we had this big run up, was back here in 2001. And then all this is pullback. And you can see we broke the trend line. We went to this area that we had been talking about for some time. We've been talking about this zone, this yellow zone, for some time, and we did just hit it. Although I did have this red line here too, because I wasn't sure if we could actually hit that zone or not. But because there's a lot of downward pressure on oil, and when it's like that, it's sometimes you just can't hit the targets. There's just too much bearishness in the market. But you can see we've got, we got to move down. Looks like we could get a little bounce here, maybe up into this area, and certainly if you have oil and you get a bounce up into this area, you probably want to sell because oil is coming down here, likely. There's no way to say for sure, but likely oil is going to make its way over the next several months down into new low territory. If you've been watching this for any time, you know that I've been talking about maybe oil getting as far down as this line here, which is at $16. So, $16 is away from here. So we're probably talking about months. This occurring over months. Certainly, if you're long Chevron, or actually some of those stocks aren't too bad. Chevron, Exxon, because they're highly integrated companies, and so there's parts of their business that are doing very, very well, even though exploration and production is not doing very well. But just be careful in the energy market. There is risk there somewhat, given that oil itself is still very much in a bear market. Let's look at the dollar. The dollar had a little, it had this breakout, this bounce off of that zone that we've been looking at, and pulled back last week, but now is bouncing. So I think the lows for the time being are in for the dollar. I don't think there's risk. I mean, there's always risk, but I don't think there's a high probability that the dollar would come back here. I think it's more likely that the dollar bounces from here and continues higher to new highs, probably up around that 102 to 105 range, something like that. So let's see what else we have. We've got gold. Gold we've been watching very carefully. You can see gold had a really good rally off this bottom down here and ran up. It actually ran past our little zone here that we drew, and it's pulling back. Now, let me zoom in a little bit better here so that we can kind of zoom in on the price action here. I think what you could be seeing here is just a little consolidation, because this is a really strong run right here. I mean, anytime you have this kind of action, the market has to digest some of those gains. So you could see the market pull back just slightly here, maybe to there, and then come up and make actually a new high around this 1400 area, maybe even a slightly higher. And then we're going to get a pretty good pullback in gold, probably something like this, and there'll be another buying opportunity. But I think gold is probably lower for the time being until we get down below, until we pull back down below these lows right here. I don't know what those lows are, 1350 or so. pulls back below those lows, rallies to new highs, and then we'll get a more protracted pullback that'll last weeks or months into this area below 1200. That's what I would look for in gold. Silver is similar. You've got somewhat of a similar pattern in silver. They're slightly different, but you could have silver, pull back to just slightly lower low below this low here, and then run up to new highs, around 22 maybe, and then you get like I said, a more protracted kind of pullback down here close to this low here around 16, maybe just below 16. So if you're looking at buying physical, metal, physical gold or silver, you can go in and trade this move when we get a little bit of pullback, but you probably should wait until after we get a pullback into this area just below 16. That would be a good area to buy gold or silver, especially if you're trying to buy the physical metal. Okay. One of the things that I wanted to show was I take some stuff from Elliott Wave International, which I've gotten into a little bit here on this program, but not too terribly much. And I wanted to show you guys how widespread this action is in just the global economy. Okay, so here's the Shanghai index. You got this run up. Into 2007. This pullback into the 2008 time frame or something, and then a new run up to 2015. But notice this is a lower high. So we've got a downtrend starting in the Shanghai composite, and probably going to head this way. Then if you look at the Asian Pacific index, so this is like, I don't know, Korea, and Australia might be in here. I'm not sure who all's in here, but India maybe. And same kind of thing. You got a lower high in 2015 and a run down, okay? And then you look at Europe. Whoops, I didn't mean to do that. You look at Europe. I want to make sure everything's on the screen here. Same kind of thing. You got this top in 2000, run up into 2007, lower high, and then now 2015, lower high. So you got, clearly Europe is in a downtrend, and, likely going lower from here. Here's 2000, 2007. You almost got a head and shoulders happening here on this chart, this world index. So you got it, here's your head and shoulders kind of look. And, with your neckline like right here. So this is looking really bad. Now this is big picture stuff, right? So, you just want to be cautious about putting new money to work and things like that. Now, this is an interesting chart because this is the Dow Jones Industrial Average divided by gold. So you could think of this as like the real value of your money, and you can see that according to these guys anyway, that the most prosperous year, the last most prosperous year we had was in 1999, the end of 1999. Since 1999, the standard of living in the United States has been going down, according to this chart. Now, if you look at the Dow Jones Industrial Average, without being divided by gold, we got higher highs. But clearly there's not as much value here, at least when you compare it to the Dow Jones Industrial Average gold chart, as there was back here in 2000. So you got higher highs being created, but nominally, or if you take into account the value of your purchasing power, we're actually less prosperous right now than we were in 1999. So, that's just what you've got going on. Now notice that the United States, this DJIA That's the United States. Notice it's the lone one at the top. All these others have already topped and rolled over. So you've got a situation where, we're kind of the last holdout, and we're at a precarious place in our particular market, and I'll show you that in just a second as I scroll forward here or scroll back. I want to make sure okay. So I'm going to zoom in on these, and we're going to talk about these a little bit. So in Elliott Wave, and the reason I'm bringing up Elliott Wave is they're very good at this big picture stuff. So right now they've got 3 different options, and to me, at least for right now, this is the least likely option. But this option says that so far we've had like wave 1 of this final series of waves. So what does that mean? That means there would be a 2, and then a 3, and then a 4, and then a 5. So this puts the top out maybe a year from now. Okay, this particular option right here. I'm sorry. This is probably they have it on the top here, but I think this is a different kind of, what this chart is, they're calling this a potential ending diagonal. So this is wave 1 here. Wave 2 would be here. Wave 3 would go to a new high, but not too much higher. And wave 4 would be like this, and then wave 5 would be like this. So you got this kind of topping with a convergence. Sorry about that. With this price actually kind of converging like so. This is called an ending diagonal. The key thing about an ending diagonal is it signals the end of a trend. Now, which trend does it signal? The end of this whole trend that goes all the way back to 2009. So that means, like boom, the wheels fall off. I think, my personal opinion is this is the second most likely option. So let's talk about the one that I think is potentially likely right now, which is kind of scary. And this is why I want to bring this one up, is this one here that says that the top is recently in. Now, I'm going to talk in a second about how you can tell which one is, the right one. But this one says the top is in, so we would have some sort of move. They show this arrow coming pretty deep, but it would be at least to here, and then you could have some sort of correction here, like so, and then you would have some giant move down like this. Okay, this shows this wave system being complete. So I don't know. To me, this is very likely given just all this other stuff you see in the market. I'm going to show you a picture in a second, and it's the main reason why I think this is the most likely right now. So just remember that chart. And then to me, the least likely chart is this one right here, because it's showing that this move here was just the first wave of many more. So you'd have let's say a pullback. They're showing it to there, but I think maybe you could get a pullback to there, and then a run up even higher like so. I don't even know if you can see these, and then a pullback maybe like this, and then another run up. So this is the one that would put us into next year, this one right here. So I think this one's the least likely right now, and I'll demonstrate that in a second. I think this one's likely right now, this ending diagonal, or the top is in. Now, how are we going to know the difference? Well, let's say that the market on this one only pulls back to right here and then takes off, and it takes out the old high. It takes out this old high here. Well, then the ending diagonal is likely the pattern, and so we'd have one more pullback to a higher low, and then another new high, and then the end. Okay. If the top is in, the difference between The ending diagonal on the top would be whoops. Hopefully y'all can see these. I didn't check to see if this was going to be lined up good. If this is taken out, this low right here is taken out. So if we come down to right there, then the top is in. So this low right here, this most recent low from like June 27th or whatever it was, right around the 4th of July, is super key. If we come back and we take this low out, then the top is in, okay? What we would expect to happen then is we expect to get some sort of correction back like this, and then we would look for, the bottom falling out. So this low is super, super important. We're going to be watching it very, very carefully here on the Middle Class Investor, and we'll be pointing it out to you guys. Okay, wrong direction. Okay, that's bonds. Okay, this is the chart. This is why I think that these are, why I think, one scenario is more likely than the other. And hopefully you can see at least most of this. But this is a chart of the Dow Jones Industrial Average, and there's two groups they're talking about here. Okay, one is large speculators, the other ones are commercials. Okay, speculators are like hedge funds. Let's just say hedge funds, just to make things simple. Commercials are well, like in the commodity market, commercial would be, Okay, I had to move my location. We're back on this. We're back on this chart, and again, this is Dow Jones Industrial Average. But in the commodity market, large speculators are the trend followers. The people that the trend is up, the trend's going to continue up. They're the buy the dip crowd, okay? And the commercials are people that are actually in the business. So if it was like coal and the price of coal was cheap, they would be buyers of futures. Or if the price of coal was high, they'd be sellers of futures, things like that. So there's these two groups. There's ways of tracking these groups. There's companies that do it. And the interesting thing, though, is we're at, and I know you can't see the high up here, but we're at new highs. We're at all-time highs in the Dow Jones Industrial Average. And the speculators, the hedge funds, think it's even going to go higher, okay? And the commercials say, I'm a seller here because that's a good price. This is the widest these two have been apart in decades. I mean, they just don't get any further apart than this. So you've got a huge group of people who think the market's going to go higher from here, and then you got an equally large group of huge people that think the market's going to go lower from here. Usually these groups, they're not this far apart. So that's why I think we're probably either the top is in, or we're going toward the ending diagonal scenario. So, but this is a pretty telling chart here. I just wanted to point this out to you. Now, here's a similar chart. This is in the bond market. Now, you've heard me talk about the bond market, and we're not going to be able to get this whole chart on here. But same kind of thing. The bond market, notice this pattern. We've been talking about this pattern. But this is an ending diagonal pattern. So you had this, notice how the price just gets tighter and tighter. Now, this is a fairly large ending diagonal pattern, but it's a termination pattern. So this means bonds are going to start falling pretty rapidly, and it's going to wipe out all this rise in the bond market on a pretty quick basis. Now, what does that mean? What have we been talking about? If bonds go down, then interest rates go up. So you're talking about the collapse of this pattern is really going to rocket interest rates up. But notice, again, the same thing is going on. You got this huge spread between commercials and large speculators. Again, decade-wide spread. I mean, they just haven't been this wide apart in decades. So that's going to catch a lot of people off guard in the market, and it's going to create some scenarios that are probably likely to be bearish for the general market. So so the world, all the rest of the world is already topped. That's what this is showing. This is the Dow Jones Industrial Average, and the large specs and the commercials are very, very far apart on their opinion and the direction of the market, which is usually happens at turns. Same thing in the bond market. And then these are the different scenarios. And like I said, to me, this one here is least likely. And this one is either, I don't know which one's first. There's no way to know. But we will be watching this previous low here very carefully. If we take out that June 27th low, or 28th, or whatever that day was, if we take out this low right here, then we're looking at an ending diagonal likely. If we don't take out that low, I'm sorry. If we let me say that again. If we take out this low, we're going to take out the low in both cases. The key is, does it bounce and start to go higher? The ending diagonal is a little bit trickier because you have to it has to bounce and then make a new high. Then you know you're in an ending diagonal. But if you're not in an ending diagonal and the market's already topped, obviously this low is going to be taken out anyway, right? This low right here. But the difference is, so will this low. So if both of these lows get taken out, then the market's topped. But what I would say is, what I would do, or what I am doing, let's put it that way. Let me talk about what I am doing. Is if we get a fairly shallow pullback here, only to there, and then it starts to come up and take out new low and take out the old highs, then I'm probably going to get in the market. I'm probably going to put my 401k in, because it means that we're going to go much, much higher here, much higher than this high here. So that's what I'm looking for. If it pulls below here, then all I'm looking for is, are we going to have a correction back from here, or, and what that looks like? Does it look more corrective, or does it look more impulsive in nature? That's it. Those are the only two things I'm looking for. So hopefully that was not too confusing for you guys, because I think what we're talking about there is pretty darn important. And certainly we're at a juncture in the market that you need to have a heightened awareness of what's going on, in my opinion, to protect your capital. From time to time these happen and they turn around and they're bullish, but they're key junctures in the market where you got to really be paying attention, and we're at one of those right now. So check back in next week. We'll see how we progressed in those areas. I think even if we've topped, I mean, we're not going to take out that June 27th low in a week. It's probably going to be a few weeks or something like that. So check back in, share the link, follow me on Twitter. I'll probably maybe what I'll do is I'll put some kind of updates on Twitter. That way only people that follow this video series would know what I'm talking about. So anyway, that is it for this week's Middle Class Investor. Thank you guys for coming in. Sorry I didn't have a program last week. I got busy with travel and some other things and just couldn't get to it. So, all right, we'll talk to you later. Bye-bye.